Welcome to this Thursday edition of Inside India. I'm Sri Jegarajah. Let's take you across today's headlines. The benchmark Nifty, will be trying to make a run for its first weekly gain in 2 months in a holiday-shortened week for India. JSW cements $400 million IPO debuts in the Indian market today after seeing fairly strong take-up. And hey, Delhi! IKEA expands its presence in India with its first Delhi physical store. We'll talk retail and the Indian consumer sector just ahead. A little bit of Swedish there to start the programme. Never let it be said that we don't get around. Let's take a look at these Asian markets talking about getting around. And the narrative is one of expectations of a Fed rate cut and the odds of that rising as close to 90%. So that's weakening the dollar. So that's the narrative that we are involved in the moment. Taking a break from the tariff headwinds. So it's relatively good news, but not for everyone. And of course, the flip side to a weaker dollar is that we are seeing appreciation in the Japanese yen, which is never a good look for the index heavyweights, amongst them the exporters. Partly explains why the Nikkei is down, the heaviest, by 1.3%. Now, back to India, and it's set to break its decades-old state monopoly over uranium. Government sources tell Reuters private firms will soon be allowed to mine, import and process the nuclear fuel. The move aims to attract billions of dollars to the nuclear sector and boost capacity 12-fold by the year 2047. The state will still control reprocessing of spent fuel, but a new regulatory framework could be announced during this fiscal year. In the meantime, despite tariffs straining ties, India's Atomic Energy Regulatory Board met with the US Nuclear Regulatory Commission. The two regulators met to boost cooperation on nuclear safety and regulation. An Indian delegation visited the US earlier this month for those talks. New Delhi is pushing to expand its nuclear capacity. Power generation currently makes up just 3% of total installed electricity capacity. Indian markets join us in about 40 minutes' time. Here's what GIFT Nifty futures are indicating. It was a strong session yesterday. Where we left off was 24,619. We're expected to kick off at 24,700 approximately. So that would represent an extension of the gains that we saw yesterday if that Nifty futures picture does materialise. Dollar-rupee exchange rate sitting quite comfortably at 87.451. And we'll be getting India's wholesale inflation data later today. Reuters poll is expecting it to ease further in July to negative 0.3%. The indicator did turn negative in June as both food and fuel prices fell. This comes after headline CPI dropped to an 8-year low in July at 1.55%, below the RBI's comfort band of 2 to 6%. Vegetable prices have plunged in recent months, and wholesale inflation will likely mirror that trend. On to earnings now. The operator of Domino's in India, Jubilant FoodWorks, beating quarterly profit estimates. Low-priced menu and free deliveries spurred demand. Jubilant emerged as an outlier in the segment as other fast food retailers struggled with weak demand. Its peer Devyani International, which operates KFC in India, also reported earnings. Profits dropped nearly 88% as the company boosted its ad spending to lure customers. Inflation in India is easing, but urban buyers are still cautious amid the rising cost of living and slow wages growth. And Swedish home retailer IKEA opened its first physical store in New Delhi, spanning 15,000 square feet. It follows its online launch in Delhi and the capital region earlier this year. However, it won't be the full IKEA experience. The retailer is opting for curated solutions when it comes to India's crowded cities where large stores are not feasible. IKEA already has a presence in India with stores in Hyderabad, Bengaluru and Navi Mumbai. Right, let's get more on what the consumer and the consumer trends are telling us about the broader economy. Manishi Rauchaudhary is with us now, CEO of Emma Capital Partners. Manishi, welcome to the programme. So we all know that the Indian consumer isn't homogenous. It's highly diverse, nuances from state to state, urban to rural. What are the standout themes, drivers that are shaping consumer trends and spending now?
If you look at, it separately into two different compartments, like urban consumption and rural consumption. Urban consumption has been pedestrian, and both the consumers and the consumer companies catering to that segment have been sounding cautious. On the other hand, rural consumption, which was kind of down in the dumps for much of the last 3 or 4 years, is showing a degree of improvement. And we think it's likely to remain resilient as we are expected to have a good monsoon, which essentially implies a good agricultural production. I think even the trade talks are likely to protect the Indian farmer's interest for now.
Yes.
So this is, broadly the picture at this stage. And if you look at urban consumption, I think they're suffering from declining wage growth, lack of jobs, particularly from the IT and other tech-dominated sectors. In fact, the most recent declarations by the top IT companies about reducing their mid-level workforce, that's kind of a canary in the coal mine.
Exactly.
So this is something we will have to watch out for.
Let's address that later on, Manishi. You raised an excellent point about job creation, and consumers are resilient as long as they have jobs, remember, and this is true world over. Manishi, Independence Day tomorrow, and let's talk about the immediate term and the upcoming festival season. That's always quite an important litmus test for demand. What are you expecting those events to tell us?
I would think that, consumption of particularly urban consumption would have a bit of a pop during the festive season. This time, the festive season is actually earlier. I think it's at least about a couple of weeks earlier compared to the last year. So you will have a significant year-on-year pop in the festive season consumption compared to last year. We're particularly we would focus on the consumer discretionaries, the likes of the jewelry companies like Titan or some of the auto and two-wheeler companies. Two-wheelers have not been doing well of late. Personal vehicles are doing better. But I think those consumer discretionary pockets would be the focus at this point of time. I would also talk about the entire travel and tourism industry, because that has been a small bright spot in the Indian consumers' firmament. I think even for investors, they will have to focus on very select pockets within the broad consumption universe to make money.
Yes, we were talking about this with reference to the Taj hotels and the owner of the hotel group, and he's still confident and bullish about the longer-term prospects. And let's just explore that further, Manishi. How strong is this thematic of the rise of the Indian middle class and the spending power that they bring, and how is that being reflected in growth and investment that we're seeing, especially in discretionary in the hospitality sector in India?
So, this is, in a sense, where China was about 10 to 15 years ago. And I think as affluency increases, it is to be expected that both inland travel and external outside the country, both are going to rise. And as a consequence, the hotel chains, like you mentioned, not just the top-end chains like the Taj, but also the middle-level hotel chains, which are catering to the second, third, and fourth-tier cities, they should have a good time in the foreseeable time horizon, maybe over the next decade. We would, of course, have to watch out for job creation and income expectations. That's possibly the most important driver of consumption in general. In the near term, you will have the impact of additional cash handouts. I shouldn't call it handouts, actually. It is more of the IT income tax relief
Yes.
that's been granted to the urban population, and also the government workers' wage increases, which are likely to hit later this year and early next year. They should have a salutary effect on urban consumption. But
I
I
see.
think from an investor's perspective, they would possibly wait to see that
Yes.
before committing more capital.
Manishi, what do you think of the recent data? Inflation at an 8-year low. Does that tell us that it's not all hunky-dory, really, is it, in the underlying economy, insofar as the consumer is concerned, and activity is running below potential? Is it telling us that demand pull inflation, the right type of inflation, is missing in action?
I would agree with that. So broadly, we tend to take it, with a positive lens. We have seen inflation first come down to about 2.2%. Now, the most recent month is 1.55% CPI. It is at a decade low at this point of time. It is, of course, mostly driven by food and fuel prices. But at the same time, it also reflects, quite a weak domestic consumption sentiment. And that's an inescapable conclusion. And that is why we think that both fiscal and monetary action would possibly be called for going forward. We've seen some degree of fiscal action in the budget last year, which I just talked about. Even the RBI had come up with a jumbo rate cut a month or so ago. But I'm sure both the government and the central bank would be thinking of more action in this regard. And the good part is that this, this sharp decline in inflation has opened up the space for RBI to think in those terms.
Manishi, excellent points as always. And do you think that there is a non-trivial risk of rising unemployment? And as we discussed earlier, you touched on this, the consumer in any economy stays resilient as long as they are employed and wages are rising. Is that a narrative that is at risk because of the prospect of 50% tariffs on India, and also when you consider what is happening in the IT services space and those severe layoffs that we heard from TCS?
It is something that the policymakers and investors would have to keep a close eye on, because much of India's urban affluence was driven by this booming employment in IT services in, particularly southern and western India. So if the large companies are, letting go their middle to senior middle level employees, it is something to be very cautious about. I think the silver lining here is that most of the large top-rung IT companies have actually expanded their, overall employee roster. So I think even TCS employs, I think, about 5,000 people more than they did about 1 year ago, which means that they're employing more people at the bottom of the employment pyramid. But those are employees who are coming in at low wages, right? So they wouldn't replace the really high earning members. There are other drivers, no doubt. We are seeing a boom, an explosion in the GCCs, the global capability centers. Almost every company in the world are opening, very large knowledge centers in India.
Yes.
So, I think those new avenues will have to eventually replace the old employment drivers in India.
Manishi, let's take this to a sector level and FMCG and that part of the market. We've seen a boom. We continue to see a boom, arguably, that's being driven by the younger demographic in India, and that's fueling the rise of quick commerce. Is this a trend that lasts or burns out?
Well, I think the rise in quick commerce is something that's here to stay. In a sense, and somewhat surprisingly, in this respect, actually, India took a lead over China. We're just seeing, similar companies or similar businesses come up in China, but in India, the likes of Swiggy or Zomato or Blinkit, for example, they've been in existence for the last 3 to 5 years. I think their penetration levels are still low. They're pretty much operating only in the urban centers, but they're yet to penetrate in the semi-urban or the second or third tier towns. So the growth rate over the next foreseeable time horizon is assured. But your first point about FMCG, I think, unlike these quick commerce companies, the FMCG companies are actually very well penetrated. Look at Hindustan Unilever. So their growth rate can't really be more than, low to mid single digits. Many of them are trading at very high valuation multiples in the range of 30 to 50 times. So that's a segment, the broad frontline FMCG companies, which we are not so positive on.
Understood. Manishi, how would you describe the level of debt that Indian households are incurring? And are these manageable levels of leverage, or could this lead to deeper systemic problems? And do you think the RBI has got a handle on this?
All right. Now, this is, possibly the most important point that the policymakers and the central bank are actually focusing on right now. We have seen numerous commentaries from RBI which are cautioning the banks about retail lending. There are banks like Axis Bank, which have been forced to, sort of increase their NPL levels, the declared NPL levels, as a consequence of recognizing more bad loans in this segment. On the, if you take a 100,000-foot view, Indian household debt is not really that concerning. It's about 42% of GDP. You have much higher levels of debt all across Asia and definitely more in the Western Hemisphere. But the point is that this is increased by, somewhere around, I think, 8 to 10% over the past half a decade. And while the consumers spent a lot in the post-pandemic period, and many of them actually took loans to spend, they're right now in the mode of repairing their balance sheets, which is advisable, which is good, but it also means that loan-driven spending has possibly come to an end, which has an impact on overall consumption growth in the near term.
Manishi, do you feel that the Modi administration is perhaps expending too much time, effort and political capital on pursuing trade deals when longer term demand, spending, consumer confidence, it could be even higher and more sustainable if the structural domestic issues relating to job creation, relating to affordable housing and healthcare, these very pressing socio-economic issues, in other words, should be top of mind and being addressed?
You're right. Well, I don't think I can say that the government is spending disproportionate amount of time looking at the external sector or the trade truces, so to use that phrase, because I think there is a degree of attention that the government and the central bank in particular is also paying to domestic consumption woes. I think you're right on one point. The government's attention towards job creation, domestic job creation, both in the manufacturing and the services sector should possibly be higher. We are seeing a degree of reluctance on the part of the Indian private sector to invest more. And one can understand because we're living in a period of peak uncertainty, not just externally, but also internally. One doesn't know how domestic growth would pan out. So it is, I think, the government could possibly do a slightly better job in terms of alleviating those, those concerns and those uncertainties which the private sector is perceiving right now.
Manishi, how concerned are you about near-term risks, the risks of rising oil prices, tariff-led growth concerns? If 50% tariffs hits, what's going to be the spillover into the macro and the Indian consumer?
Yeah. Well, I mean, an honest answer is we're still struggling with this because, first, the numbers are at this stage pretty simple. I mean, India's exports to the United States, which are about $86 to $87 billion, that's about 2% of GDP. Out of that 86, 87, I think about 35 billion as of now is exempt. These are pharmaceuticals and electronic goods like smartphones. But that operative word is as of now, because the policy response from the United States is so volatile that one doesn't know when that would change. If I believe that the remaining part, which is about $50 billion, declines by about 10 to 15%, that would mean somewhere around 0.1 to 0.15% impact on Indian economy. But that's only the direct impact, which would obviously have more second-order impact as well in terms of jobs, in terms of domestic consumption, and so on. So one would have to look at how the trade negotiations continue. August 25th is an important date. August 27th is the deadline. And not only with the United States, but also with the other countries, whether India is able to neutralize that pressure.
And we understand that Prime Minister Modi is going to be in the United States for the UN General Assembly, and perhaps there might be some opportunities there for direct FaceTime talks with President Trump to salvage a trade deal and salvage the trade relationship. Manishi, it's been a fascinating conversation. Thank you very much indeed for joining me. Manishi Ray Chowdhury there from Emma Capital Partners. We're back in 2 minutes. Welcome back. Here in Singapore, we got earnings from Capital Land Investment earlier this morning. JP Ong got a chance to speak to the group's CFO to break down those numbers. And JP, the company has also recently pledged massive investment in India. Tell us more about that and how they're handling this macroeconomic uncertainty.
Certainly, Sri. And again, this will further enlarge Capital Land Investment's footprint in the subcontinent. They currently have about 18 business parks and industrial centers there, with 6 of them actually in the Maharashtra region, where this investment will go into, 4 data centers under construction, about 9 lodging facilities there. And this will then be further enlarged actually by the $2.2 billion investment they want to make in the state of Maharashtra, mostly around Mumbai and Pune. Now, this is a big step actually for them, and there are a lot of details that have to be worked out. And we did speak to the CFO, Paul Tom, earlier on today as to what this will mean for Capital Land and when we can start to see the first milestones or the first investments and funds deployed into India when this might actually happen. And here's what he told us with regards to these big and encouraging plans that they have in India.
We're very excited about India on a whole. Strategically, we've been rebalancing our portfolio. We've been growing in markets like Australia, Japan, and India, being the three markets that we are trying to make a big push into because of structural factors, demographic factors. We really believe that there are strong trends behind them. So in particular for India, given the young population, strong growth, domestic market, we believe there are a lot of opportunities there. In terms of business parks and logistics, we're actually already one of the leading players in the market. Data centers, we've been making a push over the last few years. We have 4 under development. 1 we just signed a hyperscaler contract on. And we've received quite a lot of interest from investors to invest alongside or behind us to grow both data centers and their India exposure. I think globally, a lot of folks see the potential in the market and are looking to rebalance. So for us, we've been there for 30 years. We think that now is a chance for us to really expand our operations there, increase market share, and really generate strong positive returns out of the market for our investors.
So this $2 billion investment, can you give us an idea of what the first milestones are in terms of when the first projects might come online based off of this investment?
So we have a number of projects already running in the market through our India Business Trust, Capital India Trust, and a number of private funds we have there. So we have 2 India Logistics Funds and 2 India Business Park Funds. So those continue to deploy. I think where we're hoping the shift will be is we're hoping to raise an India Data Center Fund by the end of the year. Or early next year, and that would be fresh investments pushing into the space. We also expect that our 2 India logistics funds that have done well, we're expecting to capture some of those benefits and launch 2 new India logistics funds in the coming months.
Now, currently, when you look at the funds under management for CapitaLand as they pivot towards this asset-light strategy, only 7% of that actually is from Indian assets. But there was highlighted, Sri, that rental reversions for many of their Indian assets actually continues to trend upwards, in contrast to the declining rental reversions we're seeing in China. So this could also be CapitaLand starting to shift a little bit more focus on India and its growth prospects, and perhaps weaning a little bit off of China in the future.
Fascinating, and that really reflects what our previous guest was saying about the momentum associated with the global capability centres and that build-out and investment in India. JP, excellent report. Thank you very much indeed for that. Coming up, we will talk about the Indian market with Ask Private Wealth. Stay with us. Welcome back. You're watching Inside India, some of the stories that we are keeping tabs on. Protests erupted across India yesterday as workers and farmers rallied against President Trump's tariff threats. Trade unions called upon workers to join in a nationwide day of resistance, demanding that India stands firm against the trade pressures from Washington. India is facing a 50% tariff rate, the highest among US trading partners. And India's Congress party member Rahul Gandhi slamming the country's electoral system, saying that it suffers from serious discrepancies. He has threatened to take legal action against the system. The opposition party member recently accused authorities of tampering with voter rolls by adding fake names during the 2024 general election and other polls. The BJP and the Election Commission have denied his allegations. India's Supreme Court has ordered the removal of stray dogs from Delhi and its surrounding areas in response to the growing number of dog bite cases. Authorities have been given 8 weeks to set up shelters to relocate the strays. Animal welfare groups have criticised the order, calling it impractical. And we are counting down to the market open in India, and this is how we are shaping up. Let's give Nifty futures one last time before we get to the market proper, which will be in about 15 minutes. 24,700, give or take a few points, is where we're expected to kick off. So that would represent an extension of the gains that we saw in yesterday's session on Wednesday for the benchmark, which left off at 24,619. Let's give you the dollar-rupee exchange rate. Remember that we have been dealing with a weaker dollar environment for quite some time, and compounded now by the expectation that we will see a rate cut by the Fed in September. Dollar-rupee exchange rate looking firmer at 87476. Now, chatter around regulatory overhauls growing in India. The Reserve Bank of India has proposed a framework for using AI in the financial sector, and it aims to promote AI adoption while managing the risks. The recommendations include building digital infrastructure for indigenous AI models and forming a risk opportunity oversight panel. Excuse me. Separately, markets regulator SEBI wants to bring algorithmic trading under formal regulations. Currently, practices like algo and proprietary trading come under broad guidelines, with the regulator issuing circulars as and when needed. This comes after SEBI barred US-based trading firm Jane Street from the Indian markets, citing algorithmic manipulations. And we have a new joiner in the markets today. JSW Cement lists in less than an hour. Its $416 million worth initial public offering was fully subscribed. Both institutional and retail buyers bid for the maximum amount of shares allotted to them. The cement maker, part of the JSW Group, is aiming for a valuation of around $2.3 billion. Investors are betting on rising government spending in infrastructure and a robust property market, and we'll be watching how shares open up. Let's get more on the Indian markets and how to approach them, given the balance of risks out there domestically and externally. Of course, Somnath Mukherjee is with us now, CIO and Senior Managing Partner at Ask Private Wealth. Somnath, welcome to the programme. First of all, can you explain why you're recommending what appears to be a rather defensive tilt to portfolios?
Morning, Sri, and thanks for having me. The reason is that India is probably in the last legs of what is called very widely in India time correction in the market. We haven't had a significant movement up or down since September of last year, primarily driven by a couple of factors. One, valuations had gotten stretched, are still a little bit stretched if I look at numbers today. And that has dovetailed with, coincided with a slowdown in earnings. After a good 4 or 5 years of really, breakneck earnings growth post-COVID, corporate India has seemingly taken a breather in the last 1 year, and earnings growth has slowed down and slowed down considerably. We ended the fiscal year 25 with market earnings growth anywhere between 6 and 7%. And hence, if you take the duo of stretched valuations and slowing earnings, it just makes sense to be a little cautious about fresh incremental commitments into the market. On the other hand, though, the trifecta that determines equity prices, so there's valuation, there's earnings growth, and there is liquidity. The last leg of the trifecta is in blazing green shape. System liquidity has turned into massive positive thanks to RBI action over the last 2 or 3 months, and capital market liquidity remains as strong as ever. And hence, it's also not a market where you could take a decisive underweight call and stay out, which is where we sort of coalesce to a view that it's better to be invested, but be a bit defensive in terms of how we invest our money in.
Hence, neutral equities, overweight domestic and large caps. Does it come down to Somnath, a value opportunity? And if so, is that where the value is?
See, value is relative, and especially in the Indian context, India has traditionally, for close to 3 decades now, been a growth market. So searching for value in the traditional measures of value, as we know in the rest of the world, may not yield too much in the Indian context. But structural growth drivers of India are still very strong. Macro fundamentals are in amazing shape, whether it is the current account, inflation, or fiscal deficit. All three are in amazing shape. So the base for the new round of bullishness, if I may use that word, in prices is very well set. It just requires a pivot moment, and as we know from many years, pivot moments can never be predicted. But once that pivot moment comes, the market's structured very well, or the economy is structured very well from a macro fundamental perspective. It just needs the cycle to turn a little bit. And hence, the positioning is more around companies that can weather any short-term volatility a lot better than others that may be a lot more vulnerable to short-term shocks in the system.
Understood. Somnath, how are you approaching this at a sector level, and how are you approaching consumption retail part of the market, given the somewhat mixed signals governing urban and rural demand? Festival season is approaching, Independence Day tomorrow.
Right. So first of all, we are extremely positive on the financial space, especially banks and the larger non-banking financial companies. That's one space that we think is well positioned and could also represent some level of quote-unquote value, as you might put it. So that's one space that we're really positive on. As far as consumption is concerned, it's a bit of a fork right now. Rural consumption, so themes around rural consumption seem to be better positioned than themes around urban consumption. Urban consumption has been slowing down for the last 3 or 4 quarters, despite the fact that the tax cuts announced in the last budget have taken impact. We haven't yet seen it sort of showing color in terms of actual numbers on urban consumption indicators, but rural consumption has remained strong. The monsoons, which is sort of a mild indicator of how things will shape up on the rural side, have been good, both in terms of overall quantum as well as in terms of spatial distribution of rains this year. That should be good news for rural consumption as well. Independence Day comes up tomorrow. Festive season rolls in soon after. So there is a lot of hope that there is a pivot moment in terms of the cycle on consumption turning. But I would be a lot more confident about the rural themes than the urban themes as of.
Somnath, should we be unduly concerned about the event risk associated with the tariff story? 25th of August is when the US delegation is in town to start the 6th round of negotiations. 27th is when is the deadline for 25% additional tariffs on India. Is there going to be an element of buy the rumour, sell the fact on those stories? And
I would rather
how would you sum it up?
Switch it the other way, which is that hope for the best but prepare for the worst. I don't think there was any base case that would have left India as the highest tariff country or a trading partner of the US if anyone was talking, say, 1 or 2 months ago. But here we are. India has the highest tariffs of all US trading partners or all major trading partners around the world. Hopefully this gets sorted out, and
Yes.
it would be very odd if India remained the highest tariff trading
Indeed.
partner of the US in another
Indeed.
2 or 3 months.
And Somnath, the way that this is manifesting is that FIIs have been selling out of India, although domestic investors appear to be more sanguine. Do you think we've seen the worst of the flight of foreign investors, or is there more to come?
I think foreign investors are taking the relative value call. Obviously, India is richer than rest of emerging markets, and Indian earnings growth have slowed down. So they're taking the relative value call, and they'll probably reverse that call once India's growth momentum comes back. But honestly, not such a big issue anymore. Domestic liquidity is very strong. Last month, we just had the data for last month numbers come in a couple of days ago. Mutual fund flows through SIPs, which is the single largest source of liquidity in the market, was at an all-time high. This was the third successive month when mutual fund SIPs touched all-time highs. And so was overall domestic mutual fund flows, which tripled on a month-on-month basis. So FII flows can be very easily absorbed, or outflows rather, can be very easily absorbed. There is a very strong domestic liquidity pool, and it's not just the flow, but also the base. If you look at total amount of cash being held by domestic equity mutual funds, that's at an above average level of 7.5–8% today. Usual long-term averages are in the 5–5.5% range.
Yes.
So there's a significant amount of liquidity in stock that is available for investors or Indian investors to invest in. So I'm not terribly concerned about FII outflows. But yes, the tariff question is something that needs to be dealt with. Hopefully in the next 2 or 3 months, something will give, and a political deal will be in place to take care of it.
Let's hope so. Let's hope so, absolutely, Somnath. So in that interim period, those sectors from IT services, pharma, automakers, textiles, some of which are currently, as it stands, exempt. And I'm choosing my words very carefully here because you and I know that the Trump administration does change the goalposts because everything seems to be so non-binding. How are you approaching those sectors that are potentially at the sharp end?
As of now, the sectors at the sharp end don't get reflected too much in the market, so not a variable at all. Look at what are the sharp-ended sectors, i.e. sectors that actually face the 50% tariffs today. It's gems and jewelry, it's textiles, both of which don't have too much of weightage in the markets. Forget the indices, even in the broader markets, not a massive amount of weightage. So not such a big issue. The issue is really more second-order derivative, which is both of these sectors are extremely employment-intensive, textiles and gems and jewelry.
Yes.
And if these tariffs remain at 50%, a very large part of these exports will become unviable from India. Now, at a corporate level, they will find ways and means. I mean, they will reshore, like China has very successfully done via Vietnam over the last 4 or 5 years. So I'm sure Indian companies have enough resourcefulness to do an encore for Indian products as well. But that does not immunize Indian workers. So there will be there could be rather significant job losses if these tariffs remain at 50%, with downstream impact in terms of both consumption as well as the amount of money that government has to probably put in as a backstop to provide some level of security for people who are losing their jobs.
And
so
we are already seeing that second-order derivative play out with the IT services with enterprise demand falling off, right? And TCS having to react to that, and there's an element of AI displacement too. How concerning was that? And 12,000 jobs going at TCS.
I wouldn't jump too much at that as of yet. It is a structural, and this has got nothing to do with tariffs, honestly, because IT services are not under tariff ambit yet. This is to do with the overall impact of automation, artificial intelligence, large language programming, what have you, that's sweeping the tech world. It's something that's not keeping even the US tech job market unscathed. There is no reason why the Indian IT services will fly unscathed either. But companies will, pretty sure, take pivots, corrective action, new businesses, all of that will happen. Don't see a massive amount of impact yet. Remember, the headlines look bad. The largest Indian IT services company for the first time ever triggering a bout of job losses. But look at this in conjunction with the fact that India continues to be a very strong recipient of GCCs, or Global Capability Centers.
Yes.
Companies, overseas foreign companies that are setting up centers in India, very large centers, and setting up wholesale massive IT offshoring and high quality IT offshoring projects out of India. So the aggregate consumption, demand, and everything else, I wouldn't jump into too many conclusions, but structurally it's something that we need to be aware of, and long term we need to see how this impacts the broader economy.
Long term, do you like this nascent deep tech narrative that's associated with the GCCs? I was talking to my colleague JP about this, and a big Singapore developer is really making a big bet in that regard in the Indian market with developing GCC investments in India. AI is such a double-edged sword. So do you believe that the GCC narrative has momentum in the longer term, Somnath?
Oh, absolutely, there is. A lot of people have forgotten and probably don't know that the whole IT services ecosystem in India was sparked off by a Texas Instruments investment done in Bangalore way back in the late 80s, early 90s. And that sort of spawned a massive ecosystem today, which is worth a couple of $100 billion plus in IT services exports from India today. So absolutely, I am extremely confident that this whole trend of GCCs coming into India will continue. There is no other market that offers the breadth and depth of skills, availability of manpower, and English language, familiarity that any other country can offer. So India remains extremely attractive from that perspective. And there is a lot of domestic focus, including from the government, on the entire deep tech area as well. I expect the Indian domestic market on many of these areas to be a much bigger contributor in the investment ecosystem in the next few years.
Can I bring in the government capex programmes and spending to round off? And how much of a driver does that continue to be, Somnath, for infrastructure and defence? And can I ask you a cheeky question? Do you like the story behind JSW Cement, which is coming to market today?
I wouldn't be able to speak on specific stocks, but specifically on the question of government capex. Government capex had a great run for 4 years post-COVID, CAGR of roughly 25-30%. I think that slowed down, and that will remain roughly around the nominal GDP growth this year, which is about 10-11%, maybe a little bit more. This government has established over the last 1 decade that they are extreme fiscal conservatives. They don't want to let go of that reputation at all, which means that spending will keep in line with tax revenues, and tax revenues are likely to remain in that 10-11% range. So would government capex. So while it has been one of the prime drivers, in fact, one of the 2 key pillars of growth in the last few years, we expect that aggregate capex level will be modest in that early teens sort of level. In terms of specifically defense is a high priority, hot button area across the globe. We are seeing extreme amounts of action, even in Europe, which has been sleeping on this for forever, I think, since the end of the Second World War. In India, it's obviously a very hot button area thanks to our overall neighborhood. But there is a significant amount of work happening. Fully expect some amount of reorientation of government spends towards defense in the next few quarters.
Somnath, it's always a pleasure talking to you. Thank you very much indeed for your insights, sir. Somnath Mukherjee there from Ask Private Wealth. We are back in 2 minutes. Welcome back. The markets are online. Let's bring you up to speed with the price action on the benchmark. Nifty 50 is trading like this. Steady as she goes at 24,640. Let's give you the exchange rate while we're at it. Also steady at 87,406. Now, Infosys is pushing to boost its presence in Australia. The Indian IT services giant is set to take a 75% stake in Versant Group, the cloud services arm of Australia's Telstra. The $153 million deal will close by the second half of fiscal 2026. Versant serves sectors like finance, energy, utilities, government and education in Australia. Quick check on shares of Adani Enterprises, the company's $1.2 billion copper smelter, the world's largest single location, has applied for a London Metal Exchange listing. Located in Gujarat, it can produce 500,000 metric tons annually and will start operations in May. LME listing would make it easier to trade and finance its copper. Staying with copper, Japanese trading house Mitsubishi Corp is planning to invest $600 million in an American copper mining project, which is its first such investment in 45 years. Lin has the details. Lin, thanks for joining me. And a fascinating story. I'm just wondering whether there are going to be shades and challenges associated with of the type that we saw with Nippon Steel, or is this going to be a smooth process?
Well, from what we've received in terms of the announcement itself, it sounds like it is basically a done deal here, with the expectation that the next phase will be the feasibility study that is to come. So as you were highlighting in the introduction there, $600 million is the expectation of investment. It is a joint venture with a Canadian company, of which the Japanese trading house will own 30%, so the minority stake here. When we think about Mitsubishi Corp, this is a very diversified trading and investment company, but it has been trying to up its exposure in terms of this key metal, given its use cases, particularly when we think about clean energy as well as artificial intelligence. And of course, India, as a net importer of copper, has seen exponential growth as well. So this is its first project as well in the United States in more than 40 years, with most of its other key interests at the moment in Latin America. On the point around tariffs as well, the two sides were keen to emphasize that this is in line with the US President Trump's America First, Made in America policy, particularly when it comes to critical raw materials like copper as well, and this will boost the domestic supply chain there. But the project itself is not affected by the Section 232 50% copper tariffs that came into effect at the beginning of this month. Sri.
Len, excellent reporting. Thank you very much indeed for that. I'm afraid that's all the time that we have for today's Thursday edition of Inside India. Do keep watching CNBC. Dan Murphy and Access Middle East is coming up next.